Imagine a time when the stock market was a mystery and investors relied on whispers and gut feelings. Fast forward to today, and the Finance Virtuoso channel becomes your modern-day guide to the intricate world of finance. So, you want to build real wealth? Then you need to make smart investment choices. But how do you identify truly great investments? That's what we'll cover today. This is the Finance Virtuoso channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit that subscribe button and click the notification bell right now. The ultimate prize of any solid investment is to see your money grow and multiply. But there are several other crucial factors to consider beyond just the bottom line. Number 10. Look beyond the popular markets. Most investors flock to the same mainstream markets as the big U.S. stock exchanges. While there's nothing inherently wrong with that approach, it does limit your options. Consider branching out globally to uncover hidden gems in other markets and regions around the world. I'm not saying ignore domestic markets entirely, but at least investigate some international opportunities too. You may be pleasantly surprised by what's out there. Number 9. Study the charts. Having an eye for analyzing charts and market data is key to finding great investments. Chart analysis allows you to pinpoint opportunities and avoid duds. Many investors utilize metrics like average price movement these days. It sounds complex, but there are tons of user-friendly apps and tools that make it much simpler. Chart study will also help you determine ideal entry and exit points for investments. The general rule is to buy when prices dip low and sell when they peak. Number 8. Get expert advice. If you're new to investing, the field can feel overwhelming. Many also lack time for all the required research. If that's you, consider hiring a professional advisor. But be selective, only take guidance from investors with proven success. Request details on their past performance managing portfolios and returns for clients. Insist on evidence of their competence. Be wary of blogs and forums. Identify an experienced advisor and set up consultations, even if it comes at a fee. It's one of the safest moves you can make. Number 7. Stay up on the news. One of the best ways to spot compelling investment opportunities is to regularly consume financial news and analysis. Make a habit of watching business news channels, reading industry publications, browsing investor sites, whatever fits your preferences. Don't blindly follow general market trends without doing your research. Developing this habit of staying informed will help you uncover new ideas and make smarter decisions. In our digital world of 24/7 news and constant information, it's easier than ever before. Number 6. Understand the business model. Companies with clear and straightforward business models are often the most attractive to invest in. The way a firm generates revenue shouldn't be overly convoluted or complex. It should make basic sense, like company A makes product Y and sells it at price Z through channels B and C. If you struggle to grasp how exactly a company operates and earns money, that's usually a red flag that the model is too complicated. Having a solid grasp of the business model is crucial because it informs when you should buy or sell shares. Famed investor Warren Buffett, for instance, avoids oil companies but eagerly buys into freight and logistics firms, then scales up those investments when oil prices fall and create more favorable conditions. Number 5. Look for an attractive dividend policy. Does the public company you're considering have an official dividend policy? Review the details carefully to understand their dividend rate and payout schedule. Is it annually, quarterly, or the rare monthly payout? This matters because dividends represent one of two key ways you can profit from share ownership, the other being through capital gains when share prices rise over time. An enticing dividend policy should ideally have a history of annual increases, providing a steadily growing income stream for shareholders. The cream of the crop companies knows that treating shareholders well by regularly raising dividends is vital. You want to invest in firms where leadership has your best interests at heart as an owner. Number 4. Find companies with high returns on capital. Dig into the numbers to assess a company's ability to generate returns over long periods sustainably. The best investments tend to be firms with high returns on capital and low debt burdens. In other words, they can effectively turn available capital and resources into cash flows without needing to take on excessive debt. Number 3. Seek out lasting competitive advantages. Research the industry a company operates in and scrutinize the products or services they offer. Does the firm possess any unique strengths, technologies, trademarks, patents, or other special assets that provide an enduring edge over competitors? Virtually unrivaled products and brands like Coca-Cola's classic beverage formula exemplify the kind of entrenched advantages you want to see, making it extremely difficult for rivals to realistically threaten the business. Identifying companies with concrete, sustainable advantages helps shield your investment from emerging competitors that could threaten profitability down the road. Number 2, ensure shares are reasonably valued. Even the best companies in the world can make terrible investments if their shares are irrationally overpriced when you buy. Purchasing at the right price point is one of the most critical factors for generating returns, especially if you plan to hold the investment long term. Most savvy investors hunt for undervalued assets, scoop them up at bargain rates, and then patiently hold until the market recognizes the true worth and drives the price back up to reasonable levels. But overpaying due to hype, speculation, or other distortions in a stock's pricing leaves you at major risk of losses when the inflated valuation inevitably corrects back down to reality. The dream scenario is finding quality businesses trading at fair or even discounted share prices. Number 1, prioritize companies that can weather storms. No matter how strong a business may appear, if it lacks the resilience to endure economic crises and downturns, it's a riskier long-term bet. Landscape-shifting disruptions can arise without much warning, as COVID-19 has so clearly demonstrated by sparking a brutal global recession. While some risks will always remain outside of any executive team's control, you want to investigate how a given company has navigated tumultuous periods in the past. The 2008 financial crisis provides an excellent case study. Examine how the firm was impacted then, what countermeasures its leaders took, and ultimately how long the recovery process took. Some enterprises still struggle, while others rebounded relatively swiftly. This resilience factor speaks to the core survivability of a business. All right, that covers 10 essential tips for recognizing a potential winning investment. Let me know what you think in the comments. Did I miss anything important, or could I explain something better? And be sure to hit that like button if you found this information valuable. And of course, don't forget to subscribe and tap the notification bell so you get notified every time we publish new videos packed with practical financial guidance. Share this with friends, family, or colleagues looking to level up their investing knowledge and skills. Thanks for watching, and I'll see you in the next video.